Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I am very lucky to be joined by Strategas chairman and chief investment strategist Jason Trennert to break down markets for everyone. But first, Jason, how are you doing today?
I'm doing fine. And, I don't know if everyone's lucky to have me here or not, but I'll take the compliment. Thank you.
Well, we feel lucky. We appreciate your time as always. And at it's a bit of a summer doldrums, but still plenty to talk about. And we find ourselves recording at kind of the precipice of an important earnings season. A few big names have reported, but a lot yet to come. And I guess I'm curious if there were one item or one sector that you're watching really closely heading into this season, what it might be and how you're thinking about earnings writ large.
Well, listen, I think broadly speaking, what we're watching is the interplay between slowing nominal GDP growth and a lot of these union negotiations. Now, unionization is down a lot in the United States, but they do kind of set the tone for labor. And if you do have this situation where you have slowing nominal GDP growth and you have to pay up for labor, that obviously will be an issue longer term for profit margins. And so to me, that is kind of the biggest issue in the next 6 months. In the earnings season, the expectation is that earnings will be down at the start of the earnings season. The earnings will be down about 7. They always outperform that. Earnings are always better than what are expected at the start of the earnings season. The question is, how much better will they be? We've gotten off to a decent start. There's no two ways about it. But the question really is, I think, especially when we get into some of the more consumer-oriented names, whether the resilience in the consumer is holding up or was holding up at the end of the second quarter.
Yeah, and I want to come back to the consumer in a minute, but you mentioned the unions have come into focus, and I think that's an important maybe signpost because of how focused the Fed is at this point on wage growth and how that plays into the overall price inflation in the economy. At this point, the market does not really believe that the Fed is going to be able to hike a second time after what seems to be a hike or an all but certain hike next week in July. But I'm curious what your thoughts are on the Fed's ability to get that second hike in and maybe broadly how they're thinking about the economy at this point in time.
Ross, we're going to find out together next week. I mean, obviously the headline inflation numbers were positive, were good, as we saw last week. The problem is, as you're pointing out, the Fed spends a lot of time as an institution on what we call the Phillips curve, which is just a fancy way of saying they spend a lot of time on labor. And if you're looking at some of these negotiations, some of the airline pilots are looking at 40% increases over 40 years, over 4 years rather. You're looking at obviously Hollywood. You're looking at UPS and the Teamsters, UAW and the Big Three. And so these are not insignificant labor negotiations, even though a relatively small percentage of workers these days are unionized in the private sector, but they do set the tone for the rest of labor. And it seems to me if these labor negotiations come in hot, the Fed is going to have to stay on guard because it means for the average company, they're either going to have to raise prices or take a hit to margins, which means that inflation will still be in play. We're in the quiet period right now before the Fed's announcement next week. But it wouldn't surprise me if Chairman Powell tried to talk tough after they make the announcement on what they're going to do with the Fed funds rate. And it would strike me it's likely that people would start pricing in another cut in the fall, another increase rather in the fall. But we'll see. But I think it's too early for the Fed to declare victory.
Right. And I mean, the labor market impulse that you're talking about is one of the major things that has kept the consumer afloat and spending and kind of kept the services economy really booming still. But another piece of that is all of the stimulus that was in the system. The excess savings has been widely noted in the consumer sector. That is starting to be drawn down. And I wonder if there's a sense that maybe this cycle is a little bit different because of all the stimulus. But as that comes out of the system, as money growth turns negative, do you see more of a normalization where the normal rules of play come back into the frame as we move forward?
Ross, I do, and of course, and I recognize the fact that the S&P is up about 18% year to date, which was not what we had forecasted, and because we had expected the economy to slow down. Now, I do think, if you remember, it's hard to believe, but the market actually was flat year to date before Silicon Valley Bank failed. This 18% has all come since Silicon Valley Bank failed, and that's, in my opinion, largely due to the fact that the Fed stopped quantitative tightening. It actually increased the size of its balance sheet, and then at the same time, you had a drawdown in the Treasury's general account, so the Treasury Department added a lot of liquidity to the system. But there is no free lunch. It's hard to add this liquidity without it having an inflationary impact unless it's being offset by productivity. And now, artificial intelligence could be the manna from heaven, that saves us all from being able to spend money we don't have and not getting inflation. But our view as a firm is that it's too early to tell. That artificial intelligence could save us in the long run, but it's hard to tell that in 6 months or a year. It's something that we're going to have to find out over time. So, a long-winded answer to your question, Ross, I think the normal rules are going to start to apply as it becomes more difficult for the federal government to spend money they don't have. We'll see with student loans, which are going to have to, theoretically start to be paid back, at least to some degree, this fall. And also the bond market's going to have a lot to say as to how much the Treasury Department can spend in the final analysis.
Well, a lot to keep track of, and luckily we have you all at Strategas here to take a look for us. But Jason, thank you so much for the time today. It's been really insightful, and I really do appreciate it.
It's my privilege, Ross. Thank you. Thanks, everyone.